If you've been around the crypto space for even a little while, you've probably heard about Bitcoin's 4-year cycle. It's this rhythm that's almost become a gospel. Bull markets, epic peaks, brutal crashes, and long periods of quiet accumulation, all repeating like clockwork every 4 years. And for a long time, that pattern really did feel like prophecy. It's all tied to Bitcoin's halving events, those programmed cuts in block rewards that happen roughly every 210,000 blocks, or about every 4 years. When the number of new Bitcoins entering circulation gets slashed, supply tightens, and in theory, that's what helps drive prices higher. Historically, we've seen it play out like this. In 2012, the halving set the stage for a peak around $1,100 by late 2013. The 2016 halving, that fueled the epic run to nearly $20,000 in 2017. Then came the 2020 halving, followed by the explosive rally to $69,000 in 2021. So naturally, when the 2024 halving came around in April of that year, expectations were high, and sure, we've hit new all-time highs already. Bitcoin peaked at just over $124,000 on August 14th, only 4 months after the halving. But this time, the pattern isn't quite the same. Price growth has been more subdued. We're not seeing those 10x multipliers like in the earlier cycles. From the 2024 lows to this August high, we've only seen about a 1.8x increase. And that's got a lot of people wondering, is the 4-year cycle breaking down? Now, to understand where we're going, we have to understand where this idea even came from. The theory itself traces back to Satoshi's white paper. By limiting Bitcoin's supply to 21 million coins and baking in predictable halvings, Satoshi created a model of engineered scarcity, something more akin to digital gold than fiat money. Now, over time, as more people noticed this pattern repeating every few years, the 4-year cycle gained momentum. Analysts, influencers, even institutions began building their strategies around it. We've got models like stock to flow. We saw charts from Glassnode, Bitwise, and CryptoQuant. Even media outlets like CNBC started treating the cycle like a fundamental law of the crypto universe. But cycles don't just happen on their own. They're fueled by behavior, by hype, by fear, and by the mechanics of the market itself. So if behavior changes, or if the structure of the market evolves, well, then maybe the cycle does too. And right now, that seems to be exactly what's happening. So let's break down what has actually driven these cycles over the years, because it's more than just the halving itself. At the core, yes, we've got the supply side. Every halving reduces the number of new Bitcoins that miners receive, cutting the issuance rate in half. In 2024, that meant dropping from 6.25 Bitcoin to 3.125 per block. That's fewer coins entering circulation every day, which tightens supply, especially if demand stays constant or grows. This simple dynamic, reduced supply meeting steady or rising demand, has historically created that perfect storm for price increases. But supply is just one piece of the puzzle. Demand plays a massive role too. In the early cycles, that demand came mostly from retail investors, people like you and me, discovering Bitcoin for the first time. Media hype helped fuel it. We had the ICO boom in 2017, and then DeFi and NFTs in 2021. Each of those waves brought in fresh capital, often driven by FOMO more than fundamentals. But demand doesn't just come from excitement. It also moves with the broader economy, especially with global liquidity. Bitcoin's price has actually shown a pretty strong correlation with M2 money supply over the last 5 years, about 85% actually. When central banks pump liquidity into the system, when they print money, whether through stimulus or quantitative easing, that money tends to find its way into risk assets, including Bitcoin. Right now in 2025, global M2 is sitting at a record $55.48 trillion. And if that trend continues, some analysts think Bitcoin could reach $170,000 just on liquidity momentum alone. And then we have institutional inflows. Corporations like MicroStrategy, ETFs like BlackRock's IBIT, and pension funds are putting serious money into Bitcoin. As of this August, IBIT alone holds over $85 billion in assets. That's more than 700,000 Bitcoin. And this type of demand is different. It's not speculative in the same way retail demand often is. Institutions tend to buy in larger amounts, they hold longer, and they treat Bitcoin more like a strategic asset than a quick trade. But cycles aren't just about supply and demand. They're also psychological. Long-term holders tend to take profits near market tops. We've seen that pattern over and over again. And after the sell-off, there's usually a period of accumulation where conviction builds quietly below the surface. On-chain metrics like those from Glassnode actually map out these phases of euphoria, fatigue, and rebirth pretty clearly. And finally, there are always external shocks to consider. Regulatory changes, geopolitical events, and even tech upgrades like the Lightning Network, all of these can either accelerate or disrupt the rhythm of the cycle. So yes, the 4-year cycle was born from the halving, but it's been shaped again and again by a much bigger web of factors. And that's where things start to shift. Now here's where things get interesting, because while Bitcoin's 4-year cycle still shows signs of life, this current market is acting a little different. Now take the latest halving. It happened in April of 2024, and Bitcoin reached a new all-time high around $124,000 in August of 2025. That's 16 months post-halving, which actually lines up with historical patterns. In both 2017 and 2021, we saw peaks around 12 to 18 months after the halving. So at first glance, you might say, well, the cycle is alive and well. But when we look a little deeper, we see some big shifts. For one, the post-halving rally has been more muted than in previous cycles. From the 2024 lows, Bitcoin has only done about a 1.9x. That's a far cry from the 94x surge in 2013 or the 20x in 2017. The market just doesn't have that same explosive momentum. Volatility tells a similar story. Bitcoin's 30-day realized volatility has mostly hovered between 40 and 60% this year. Still volatile, yes, but much more tame compared to past cycles, which often spiked between 80 and 100%. That's a sign of a more mature asset class with deeper liquidity and larger players. Even on-chain behavior has changed. Long-term holders are taking profits, but in a more measured, sophisticated way. We haven't seen the panic sell-offs or the euphoric blow-off tops that usually define Bitcoin peaks. The biggest correction of this cycle so far, only about 28% back in January this year. So what's behind this shift? It's not just the halving anymore. Macro factors like inflation, interest rates, and central bank policy are playing a much bigger role. Bitcoin is more correlated than ever with risk on assets like the S&P 500. We saw it during Fed meetings, inflation prints, even Treasury auctions. This cycle is being driven as much by macro liquidity as it is by block rewards. Institutional inflows are another major force reshaping the rhythm. In 2025 alone, spot Bitcoin ETFs have brought in over $118 billion, with BlackRock's IBIT holding over 700,000 Bitcoin. These flows are consistent and steady, unlike the emotional retail surges we used to get post-halving. That's why some analysts are saying this cycle is breaking. Matt Hougan from Bitwise is one of them. He's argued that ETF-driven demand has essentially front-run the halving narrative. It's smoothed out the wild swings, and we're already seeing it. There hasn't been a real alt season just yet, no retail mania, no dramatic blow-off top. Others, like the team at Glassnode, think the cycle is still there. It's just evolving. Maybe we still top out later this year. Maybe it's just taking longer or playing out differently because of this new market structure. Whatever the case, the takeaway is clear. Bitcoin's 4-year rhythm isn't gone, but it's no longer the only beat driving this market. The supercycle theory is one of the more exciting and controversial ideas in Bitcoin space right now. Instead of repeating the usual 4-year pattern, boom, crash, accumulate, halving, repeat, the supercycle suggests something different. A long, grinding bull market that stretches across multiple years, driven not by halvings, but by broader economic forces and institutional adoption. Under this theory, the extreme 80% crashes we've seen in the past could be replaced by more modest corrections. Think 30 to 50% instead of full-on bear markets. And rather than peaking every 4 years like clockwork, Bitcoin would experience extended upward trends as liquidity cycles, regulatory clarity, and big money inflows drive more sustainable price appreciation. And there's evidence this could be happening right now. Now, personally, I am not sold on this idea, so I want to urge you to be cautious with what I'm about to cover. The flows from spot Bitcoin ETFs in 2025 alone have crossed $54 billion, helping Bitcoin rally steadily throughout this year. Sovereign interest has also increased. Countries like El Salvador continue to double down, and policymakers in the US, Brazil, and parts of Southeast Asia are rolling out pro-crypto regulation. Now, importantly, the supply shock narrative tied to halvings is starting to take a backseat. US spot Bitcoin ETFs have actually driven 75% of Bitcoin's second quarter of 2025 rally. And according to on-chain data, these ETF inflows have outpaced the effects of the halving by more than 10 to 1. That kind of institutional activity supports the supercycle view, where cycles are no longer clean 4-year rhythms, but messy, elongated waves driven by global liquidity and steady inflows. Now, of course, not everyone's buying it, again, myself included. Some analysts still see this as temporary. They point out that external shocks, like a sharp Fed pivot or geopolitical crisis, could easily trigger another brutal correction, sending Bitcoin back into the kind of bear markets we've seen before. So the debate continues. Are we evolving into a super cycle, or just writing a smoother version of the same old story? Time will tell. But one thing is clear. Bitcoin is no longer just a retail-driven asset riding on halvings and hype. The forces shaping this market are bigger, deeper, and more interconnected than ever before. Let's talk about the institutional influence on Bitcoin because it's becoming impossible to ignore. On the surface, it's easy to see the positives. Institutions are bringing maturity and depth to the market. In 2025 alone, actual inflows from institutions have totaled around $118 billion, mostly driven by spot Bitcoin ETFs. These inflows aren't just symbolic. They've helped reduce volatility and increase mainstream trust in Bitcoin as a legitimate asset class. Just look at the numbers. Bitcoin's 30-day volatility has dropped to around 40 to 60%. Still high compared to equities, but far lower than the 80 to 100% swings we saw in earlier cycles. Now compare that to traditional markets where stocks typically sit around 15 to 20%, and you start to see the convergence. Now, institutional investors aren't just buying Bitcoin, they're integrating it. A 2025 EY survey found that 59% of institutions plan to allocate more than 5% of their assets under management into crypto, up significantly from 2024, and more than 86% either already have exposure or plan to enter within the next year. We're also seeing a huge impact from 401k plans and pension funds. ETFs have made it easy for retirement accounts to get price exposure to Bitcoin. For everyday people, it's becoming just another line in their portfolio, a line that happens to be deflationary, censorship resistant, and global. But this influence comes with trade-offs. While the inflows are impressive, they've also changed how the price of Bitcoin behaves. In early 2025, despite billions pouring in, Bitcoin still dropped 28% from its January highs. Why? Because institutions don't just buy, they also short. They hedge. They use complex derivative strategies to manage exposure. And in doing so, They introduce new forms of volatility that don't follow traditional retail-driven patterns. In the past, Bitcoin would rise and fall based on sentiment and scarcity. Now, it can be moved by quarterly earnings and reports and fund rebalancing. And then there's centralization. As of now, institutions control over 22% of ETF-held Bitcoin assets. That's a huge chunk of supply sitting in custodial accounts, governed by traditional finance infrastructure. It makes Bitcoin more accessible, yes, but also makes it more exposed to the very forces it was designed to escape. So while institutional entry has helped legitimize Bitcoin and dampen some of its wild volatility, it's also reshaping the market's DNA. The question now isn't just whether the price of Bitcoin will go up, it's whether it can keep its soul intact while doing so. Now let's talk about the darker side of institutional influence: manipulation risks through ETFs and the regulatory blind spots that make them possible. In the United States, Bitcoin is classified as a commodity, which puts it under the CFTC's oversight. But here's the catch: the spot market itself isn't tightly regulated. So even though the ETFs are approved and monitored by the SEC, the underlying assets and price discovery mechanisms are still operating in a fairly open and sometimes vulnerable environment. That gap creates all kinds of opportunities for manipulation. For example, ETFs introduce a concept called paper Bitcoin. These are claims on Bitcoin, shares that can be traded on traditional exchanges, without necessarily moving real Bitcoin on-chain on the Bitcoin's public, auditable, peer-to-peer network. That opens the door to overshorting and excessive leverage, where massive sell pressure can be created without any actual coins being sold. And when prices drop, authorized participants, the institutions that issue and redeem ETF shares, can trigger forced sales of Bitcoin held in custody, accelerating crashes even further. Then there are leveraged and inverse ETFs, which are designed to profit from Bitcoin's downside. These financial instruments amplify short-term moves, so a 5% drop in Bitcoin could become a 10% loss for holders, or a 15% gain for short sellers. And because they rebalance daily, they can unintentionally push volatility into the market, especially during turbulent periods. Rehypothecation is another problem, where the same Bitcoin can be pledged as collateral multiple times within the financial system. It's common in traditional markets, but in crypto, it introduces systemic risk. If one firm defaults, the ripple effects could cascade through every party that touched that same collateral. You guys remember Anchor Protocol? Very similar. A 2025 study found that the launch of US spot Bitcoin ETFs actually decreased volatility in some cases, but increased asymmetry into price discovery. That means prices are being influenced more by arbitrage, futures trading, and ETF flows than by actual Bitcoin demand on-chain. So far, we haven't seen any massive scandals or collapses tied to these ETFs, but the concentration of supply is raising red flags. At the moment, the top ETFs collectively control about 771,000 Bitcoin. That's more than 3.5% of the total supply, essentially held by a handful of Wall Street giants. Regulators are aware of these risks, but you know them. In 2025, efforts like the Genius Act were introduced to close the gaps in ETF structure and custodial oversight. But progress is slow and enforcement is still catching up to innovation. The Genius Act is definitely far more interested in laying the groundwork for CBDCs, but I digress. So the takeaway: ETFs have helped Bitcoin grow up, but they've also brought it into a system full of loopholes and perverse incentives. For the cypherpunk-minded, this isn't just uncomfortable, it's existential. So let's talk about what this actually means for individual holders, you and me, especially the difference between owning Bitcoin through an ETF versus holding it yourself in self-custody with your own private keys. At first glance, the convenience of ETFs is hard to beat. There is no need to worry about managing private keys, using hardware wallets, or understanding blockchain mechanics. And for many retail investors, especially those coming in through traditional brokerages or retirement accounts, that ease of access is what finally gets them off the sidelines. In fact, a 2025 consumer report showed that 14% of crypto-curious investors plan to make their first Bitcoin purchase through an ETF, not a crypto exchange or a wallet. And based on active ETF inflow data, around 30% of US retail investors now enter the market this way. But that convenience comes at a cost. When you hold Bitcoin through an ETF, you're not actually holding Bitcoin. You're holding a claim to an asset that's being managed, traded, and possibly lent out behind the scenes. That means you're exposed to management fees, redemption rules, and the decisions of the fund custodians, all which erode the ethos of not your keys, not your coins. Here's where it gets even trickier. In a market crash, both ETF holders and self-custody holders experience price drops, but inverse ETF holders and short sellers can profit off of that pain. That opens up a dynamic where institutional players can potentially accumulate more Bitcoin at lower prices, while retail investors sell in panic. This is why you have to subscribe to this channel so you don't do that. Some long-term ETF holders may never realize how much of that sell pressure was manufactured and not natural. At the same time, ETFs are quietly shifting Bitcoin's core identity. With every new 401k integration, with every mainstream headline about crypto exposure, that framing becomes less about sovereignty and more about price performance. Even among institutional investors, survey shows that only 34% hold Bitcoin directly, while 46% plan to use derivatives or ETFs, a clear shift toward abstracted, custodial ownership. And that has long-term consequences. Self-custody still offers the highest potential ROI, no fees, full control, and true sovereignty over your wealth. But it also demands more knowledge, more vigilance, and more personal responsibility. ETFs, on the other hand, offer easy entry points and broader adoption, but at the risk of centralizing control, undermining Bitcoin's finite supply narrative, and dulling the cypherpunk edge that made this movement what it is. So the question every investor has to ask themselves is this: do you want exposure or do you want ownership? Because in the world of Bitcoin, those are not the same thing. So here we are, 16 years into Bitcoin's experiment, watching a financial system evolve around it in real time. The 4-year cycle, it still has its fingerprints all over the charts, but it's no longer the only force shaping this market. Institutions, ETFs, liquidity flows, and macro policy now cast a long shadow over what used to be a retail-driven rhythm. Maybe we're entering a super cycle, and maybe we're just watching the same dance play out with different partners. Either way, this is not the same game it was in 2013. And yet, at its core, Bitcoin hasn't changed. It's still a tool for sovereignty, still a finite, decentralized asset that anyone, anywhere can access without permission. What has changed is how people interact with it. We now have a choice. Do we want to chase its price like any other tradable ticker? Or do we want to own it, live it, and understand what makes it different? Because let's be honest, exposure to Bitcoin is not the same as ownership of Bitcoin. One is passive, convenient, and custodial. The other is deliberate, inconvenient, and free. One says, I hope the number goes up. The other says, I hold this because no one can take it from me. It grants me full control over my wealth. So, as we move forward, whether into another euphoric bull run or a sobering correction, let's remember what made this movement matter in the first place. It wasn't just the profits, it was the principle, The idea that we could build something better than the system that failed us time and time again. You don't have to be a cypherpunk to believe in that, but if you're here to learn more, to go deeper than just the headlines and hype, check out learningcrypto.com. You'll find education that respects your time, your intelligence, and your autonomy. Because in the end, Bitcoin isn't about betting on price. It's about opting out of a broken system and building your own. And that's something worth understanding and owning fully. I'd love to hear your thoughts about this topic. Do you think we're entering a super cycle? Do you think this is the same old 4-year cycle? And what's your opinion on institutional involvement in crypto, specifically Bitcoin? Love to hear your thoughts. We'll have a conversation. Have a good one. Hit subscribe. I'll see you in the next video.